the Fed just lowered the federal funds rate by 0.25%. So what does that mean for you? And does it mean that interest rates for mortgages will automatically go down? Not quite. The federal funds rate is the short-term rate banks charge each other to borrow overnight. It affects things like credit cards, auto loans, and home equity lines of credit. But mortgage rates, especially fixed 30-year rates, don't move in lockstep exactly with the Fed's decision. Instead, they're more closely tied to the bond market, inflation expectations, and investor sentiment, as well as the jobs report. Here's the interesting part. Even though the Fed cut rates, mortgage rates actually went up over the last couple of days. Why? Well, two big reasons. The size of the cut. Many investors were hoping for a 0.5 point cut. When the Fed only delivered 1/4 point, markets reacted with disappointment. Another reason was future outlook. The Fed signaled that they are cooling off on additional cuts for now. That message shifted expectations and pushed the bond yields higher, which in turn nudged mortgage rates higher. So the takeaway is this: the Fed cut doesn't equal lower mortgage rates. Rates are still moving daily based on the bigger economic picture. So if you're thinking about buying, refinancing, or just curious where things are headed, it's smart to talk strategy now rather than trying to time that market just perfectly. If you'd like to see how today's rates impact your specific situation, reach out. I'd love to walk you through the numbers.